Good evening, and welcome back to Mo's wonderful channel. Today, I want to talk about economics. Now, just for background, I have 2 degrees. One degree is in electrical engineering, the other degree is in economics. According to Wikipedia, economics is a social science that studies the production, distribution, and consumption of goods and services. And I will add within a defined ecosystem. That ecosystem could be a nation, it could be a continent, it could be a group of nations, or it could be the world. So you could talk about the U.S. economy, one nation. You could talk about California's economy, a segment of that nation. You could talk about Los Angeles's economy, a segment of an ecosystem. You could talk about the European economy, which would look at all the nations that comprise Europe, because Europe is not a continent. Asia is a continent. Europe is a part of Asia. It is not a separate continent. Continents are large land masses surrounded by water. Thus, there is no South American continent, a North American continent. There's the American continent. But let's go on. This is not a geography lesson. Get a book in geography and educate yourself. Or you could talk about the global economy. You could talk about economies within industries, the services economy, the manufacturing economy, the distribution economy. Now, being a revolutionary as I am, I do not believe in the status quo. I say, fuck the status quo. I do not believe in conformism. I got a mind. I could think for myself. I do what I feel I should do, not what some little shit ass nerd decided society should do. So, I am going to present accepted economic theory. I am going to dismember accepted economic theory. Then I'm going to present Mo's, that is my economic theory. Furthermore, I will develop an economic model for nations. As mentioned, my whole objective is the creation of the black nation, which encompasses black people in America, Central America, South America, Africa, Asia, Pacific Islands, and wherever goddamn else black people may be, because we are like goddamn fucking roaches. They made us slaves, we still here. They colonized us, we still here. They lynched us, we still here. They tried to exterminate us, we still here. Niggas can't go away. So all you other races just accept the niggas are here to stay. Alright, fuck it. So I'll develop a model for the black economy. And within that model, national economic models for those nations that are black, such as in the Caribbean or in Africa. For environments wherein black people are part of a larger nation and hence can't establish their own national economy, I will talk about how black people in those nations, where they may be a minority and do not have control of the levels of power, can establish their own viable economy within the larger economy. I anticipate I do not want to keep any of these videos more than 30 minutes, so I anticipate that I might have to break it down into multiple videos, multiple segments. So let's get started. Let's talk about current accepted economic theory. In economics, you have microeconomics and macroeconomics. Microeconomics focuses on the behavior of a specific rational consumer. Note that word, rational. We will come back to it. It looks at factors such as if the price of a good increases, how will this consumer react? If they're competitive products, will he go to the other product? Will he stay with his product? The same thing if the price of a good decreases. Now, in economic theory, what controls the price of a good is the balance, or they call it the equilibrium, between demand and supply. The theory states that suppliers will continue to put out product until supply exceeds demand. Now, as long as demand exceeds supply, suppliers will jack prices up with the intent that at a certain price level, demand will start to drop. Think about it like this. You're having a party. You have a venue. It holds 3,000 people. And I used to be a club promoter. I used to be a concert promoter. I used to be a DJ when I was at Howard. But you have a venue that holds 3,000 people. The fire marshal is standing right outside. So he's got his little ticker. Once he sees 3001, he's shutting you down. But you got a line of 5,000 people trying to get in. How are you going to limit without being selective and saying, you come in, you go out? I don't like them kind of clubs. You see that in New York, you see that in LA. I do not like them kind of selective clubs. When I ran clubs, when I promoted clubs, if you fit the dress code, if you got the money, you get in, motherfucker. Fuck that selective shit. But without being selective, how are you going to whittle down from 5,000 to 3,000 people? Keep jacking up the price. You might start off $10. I'm offering it's $10 to get in. No one leaves the line. Come back 5 minutes later. All right, the price gone up to 15. You might see a few drop out the line. Come back later. The price got up to 25. You might see a whole rack of them leave the line. Now you've hit the target. That is the thinking between supply and demand. You have high demand, low supply, prices are high. You have low demand, high supply, prices are low. On the stock market, that works. In the global crude oil market, that's supposed to work. That's why you hear OPEC setting quotas and cutting back quotas and cutting back production. The objective is that will drive the prices of oil up. So that's microeconomic theory. At a basic level, it's focused on what will the consumer's reactions be to different market situations. And those market situations are primarily focused on the supply and demand of different products, on pricing of products, on competing products, on alternate products. Now, when you talk about competing products and alternate products, they're two different things. If I am selling Bic lighters and you have Amico lighters, it's the same product, serves the same purpose, but they're competing products because they're both lighters. You know how a lighter works. Fire. Now, an alternate product to a lighter would be matches or lightning. If you could light your cigarette by lightning, just know when that shit gonna strike, hold your cigarette up or your blunt up, you're good. That's the difference between competing and alternate products. Competing products are in the same family, they function the same. Alternate products, think of them as cousins. They can provide the same functionality, but in a different way. That's microeconomics. Macroeconomics now looks at the behavior and reactions of larger players in that ecosystem. It could be companies, it could be governments, it could be non governmental entities. How do they interact in terms of goods and services? Every company has suppliers, every company has competitors. All right? So, just like a consumer might buy less of something if the price is high, a company might use less of something if the price is high. An abstract, probably obtuse example might be interest rates. If the Federal Reserve raises interest rates to 10% when before there were 2%, that means the cost of borrowing money goes up. So a company that was thinking about raising cash might decide, well, you know what? Instead of issuing bonds or borrowing money from the bank, let's issue equity. So it might do an IPO or it might do a secondary offering. The difference between an IPO and a secondary offering is when a company first goes public, that is an IPO, initial public offering. Now, when a company goes public, it might not issue all of its stock. It might hold some in reserve. Let's say you're a company, you have 100,000 shares. When you go public in your IPO, you issue 50,000 shares. So you have 50,000 in reserve. 2 years later, you might need to raise additional cash, so you might do a secondary offering of those 50,000 shares. So you might issue another 30,000 shares. Now you have 80,000 shares outstanding and 20,000 shares in the house. So that's how the price of a product, in this case money, and interest is the cost of money. That is how the price of a product can affect the utilization of that product. On the governmental scale, this is where we're now talking about macroeconomics. There are two primary things that I want to look at: monetary policy and fiscal policy. Fiscal policy are those activities that a government undertakes to inject cash into the economy. Classic example would be, I think it was FDR's New Deal, where this was coming off of the Great Depression, and the objective was to jumpstart, to activate the economy. Banks weren't lending money, people were out of work, unemployment was 30, 40%. They had soup kitchens. America was a goddamn fucking 10th world country. Fuck third world, 10th world. So what FDR did, he started a lot of these huge government funded initiatives, infrastructure projects, blah, 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 blah. What these did, they put a lot of people to work. Now, when people work, they pay taxes. When people work, they consume. What does that do? Now you got a job. Now you make $50,000 a year, but guess what? Now you're giving 20,000 of that back to the government. But now you got 30,000 in your pocket. Oh man, let me go get that new car. Let me go get that new shirt. Let me go get that new ski cap. So now the guy that sells cars, now he's got money coming in. Now he could hire people. The guy that sells ski caps, now he's got money coming in. Now he could hire people. The guy that sells t-shirts, now he's got flow coming in. He could hire people. Those people pay taxes. Those people consume. And it's a domino effect. So that initial $1 billion that the government might inject into the economy, in the long run, it results in $10 billion worth of growth. That this is why Republicans are so fucking stupid. This is why they're so fucking stupid. Because that $10 billion in growth is now going to, through taxation, income taxes, corporate taxes, sales taxes, is going to more than pay for itself. They talk about debt, 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 debt. You spend $100 billion on nationwide infrastructure projects. You're going to put so many people to work. They're going to turn around, spend that money, put so many more people to work who are going to pay taxes back to the government. What fucking debt, nigga? It's some dumbass crackers, these Republicans. But let's move on. The Democrats are dumb as shit too in other areas. So that's fiscal policy. They talk about tax cuts. Tax cuts are fiscal policy because what tax cuts do, they put money back in the pockets of the consumer. The intent is that extra disposable income will result in additional consumption. And that makes sense. Here's where it doesn't make sense. Tax cuts to the rich will result in the growth of business. Problem is, the vast majority of high income earners, the doctors, the lawyers, the CEOs, the athletes, blah, 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 are not entrepreneurs. They're not. Now you look at someone like Shaq, he's entrepreneurial. People don't know, but Shaq is one of the largest land owners in this country. That's a smart nigga. But the majority of them are not. So if you got someone that's making $500,000 a year, living in $1 million home, and you give them a tax cut, and now they got an extra $60,000 in disposable income, they're not going to buy stock. They're not going to start a company. They're not going to buy a property. They're going to remodel their house, or buy a new car, or take a vacation. So, tax cuts to the rich, Republicans, use your goddamn fucking common sense. Tax cuts to the rich do nothing to spur the economy. Tax cuts to corporations, as we have seen, do nothing to spur the economy. Why? When they gave these corporations tax cuts, the thinking was these corporations run by smart CEOs would turn around, invest in R&D to create new products, hire more people, open more plants. No. What did these corporations do? They bought their fucking stock back. Do you know why they bought their stock back? If I'm the CEO and I own 100,000 shares at $100 a share, that's what, $10 million. Now, if I'm the CEO and decide let's buy our stock back, and the stock price goes from $100 to $150 because we bought it back, I've gone from having $10 million to $15 million. The majority of decisions made by corporate executives are made to benefit themselves, not to benefit the shareholders, not to benefit the consumers, not to benefit the employees, not to benefit the nation. Understand that. So that's the purpose of fiscal policy, where the government initiates some activities designed to inject money into the economy. Monetary policy is focused on two things. Well, one thing really, and that is controlling the supply of cash in the economy. That is all that monetary policy is focused on. When they raise interest rates, money becomes expensive. So less people will borrow. The less people that borrow, the less money there is in circulation. When they lower interest rates, money becomes cheap. So people will borrow more money. The more money people borrow, the more money there is in circulation. When the Federal Reserve and the Treasury sell bonds, people pay money to get those bonds. So that's taking money out of the economy. That's reducing the amount of cash in circulation. When they buy bonds or redeem bonds at maturity, they paying people money to take that paper off their hands. So that is increasing the amount of cash in circulation. Now, the Federal Reserve uses the Fed funds window. All banks that are national banks are members of the Federal Reserve. They own the Federal Reserve. The Federal Reserve is owned by banks. Let me say that again so you're no longer confused. The Federal Reserve of America is owned by the member banks who are the national banks in this nation. They answer to their shareholders, which are the member banks. The Federal Reserve is a private corporation that manages the cash supply for the U.S. Treasury. Now, through the Fed funds window, banks can borrow money from the Federal Reserve at the Fed funds rate. When they borrow money from the Federal Reserve, they can then lend that money to businesses or consumers at the prime rate or less than prime rate. The prime rate is what banks lend to the best corporations. And when I say best, I mean they have the best financial performance. They're financially stable, they're sound, they're solid. All right. Banks can also lend back to the government. Banks can lend to state governments. Banks can lend to municipal governments. So if the Fed funds rate is 2%, the prime rate might be 4 or 5%. But the rate at which you, a consumer, borrow might be 8%. That's if you have excellent credit. If your credit is not so good, you might pay 10, 11, or 12%. The theory behind the Fed funds window is that the Federal Reserve will use the banks to inject money into the economy. And the way that is supposed to work is that I am a bank, I go to the Fed, I get money. I then take that money and lend it to companies or consumers. By doing that, these companies can expand their operations, and hire more people, and these consumers can purchase goods, which increases the revenue of the companies, which allows them to expand and hire more people. So it's another domino effect. Now, what happened? After 2008, the Federal Reserve was just giving money away to banks. You heard about TARP and all that shit, giving money away to banks. Not just giving money away to banks, but taking toxic assets off of the balance sheets of banks. So as a bank, your liabilities go down, your assets go up. The logic is you can now I'm now the bank, I'm now going to take that money and lend it out into the economy. By doing so, I spur economic growth. Nah. What do these banks do? The money they got from the Federal Reserve, free money, they turned around and speculated. They started trading. These banks started trading. Instead of taking that money, putting it back in the economy, they started trading. And they made profits. Hella profits. They failed in their function as a factor in the economic equation. That is why it took so fucking long for the economy to start to recover. Secondly, by lowering interest rates, so not only did the Federal Reserve give banks money, they lowered the Fed funds rate to zero, which means the banks could borrow money free, with the intent that they would push that money out into the economy. It did not happen. That is why the stock market kept going up and up and up and up and up. Because banks had all this free motherfucking money. It's not because the companies were doing better. Like I said, do not confuse the performance of the stock market with the economy. They are not related. Not at all. People like me, we play the markets, we make money. I can make $1 million tomorrow. Did that improve your life? Did that improve the economy? No. They are not related. So we understand fiscal policy, that's the government pushing money into the economy. Monetary policy through debt issuance and redemption, as well as interest rate control. Now, I'm at about 28 minutes, so I'll just focus on modern economic theory right now. I want to attack it. In 1929, when you trade stocks, they got something called margin. What margin is, they call it regulation T. What margin is, it means that if a stock is $100 a share, and I have a margin account, and currently regulation T or the margin requirement is 50%, and the stock is at $100 a share, I could buy that stock for $50 a share. I'll borrow $50 from my broker and buy that stock for $50. If the stock goes up to $110, if I would have bought it for $100, I would have only made 10% profit. But since I bought it for $50, I make $10 off of 50, so I make 20% profit. Now it goes up to $110. I sell it for $110. I get $110. I give my broker $50, and I put $60 in my pocket. Back in the 20s, the margin requirement, I think, was about 20%. So that means for me to buy $100 stock, all I had to do is put up $20. That's cool. Now, when trading stocks and margin, they have something called a margin call. So let's say I bought this stock for $50. Or let's use another example. Let's say a stock is $200. I buy it for $100, so I borrow $100 from the broker. Now, if the stock drops down to $100, that means that I could sell it for $100 and I give the broker everything. So I'm left with zero. If the stock drops to $80, that means I could only sell it for $80, but I owe the broker $100. If I don't have that $20, the broker's short. So when a margin, what a margin call does, if that stock drops to a level where the broker determines, you know what, if he sells this, he won't be able to pay me back, they issue a margin call. What a margin call does, what it means is that now I have to put up more money, give it to the broker, a security that if this stock drops any further, I still got you. If I can't do that, then I have to sell the stock, or the broker will liquidate the stock. They'll sell it for me, take their money. What happened in 1929, you had a lot of people that bought stock on margin. You also had a lot of people that shorted stock. When you short stock, you sell it before you buy it. So how you do that? You borrow stock from the broker and then you sell it with the intention that down the road you'll buy that stock and give it back to the broker. In 1929, the Federal Reserve started to jack up interest rates. A lot of people had bought stock a 20% down payment, whatever you want to call it. The margin was 20%. So they started to jack it up. When they started to jack it up, then a lot of people started to get margin calls, which meant that they had to liquidate their stock. As many people started to liquidate their stock, you started to have a domino effect. They selling. Shit, something's going on. Let me sell. And the market just tanked. In 1987, you had the leveraged buyout frenzy. What is a leveraged buyout? Well, let's look at what a buyout is. A buyout is an acquisition. When one company buys another company. When two companies come together, it is called a merger. There are three ways to finance an acquisition: cash, stock, or debt. With cash, I buy $100 million company. Here's $100 million. We done. With equity, I buy $100 million. I got my stock price is $100 a share. I got 1 million shares of stock sitting in the house. I take that 1 million shares, give it to them. I got the company. With debt, I borrow money and buy that company. Now, if I'm one company acquiring another company, then I, the acquirer, assume that debt, not the acquired company. What was happening, you had these raiders, the Mike Milkins, Carl Icahn, all those guys, KKR, I think it was Kravis Roberts, some shit like that. And these were private funds, like venture funds. Like you have venture capitalists. These were venture funds, and they'd raise money to acquire companies. But what they started doing is borrowing money and using that borrowed money to acquire companies. Once they acquire that company, they'll then offload that debt onto that company. So that company now owned that debt. When the Fed jacked up interest rates, a lot of companies started defaulting. Then you had the margin issue, and the market started tanking. See, all busts and bubbles since 1913 in the U.S. economy are directly correlated to actions of the Federal Reserve with regards to interest rates. Whenever the Federal Reserve lowers interest rates, you create a bubble. Whenever they raise interest rates, you burst that bubble. You had the dot-com era. They jacked up interest rates. The market tanked. The bubble burst. You had the housing bubble. They gave us 2008. The Fed lowered interest rates. That was after September 11th. They lowered interest rates. A lot of people bought houses. They raised interest rates. A lot of those mortgages were APRs, which were adjustable to reflect the current interest rates. You go from paying $500 a month a mortgage to paying $1,000 a month. You can't afford it. You foreclose. I foreclose. He forecloses. He forecloses. Supply and demand. The supply of housing shoots up. Demand is not there because people can't afford it. What happens? The price tanks. All because of actions of the Federal Reserve. Currently, there is a massive bubble of debt in corporate America. Corporations, I'm talking about large corporations, have an unsustainable level of debt. If anything should happen, if interest rates should go up by 5%, you will see a lot of corporate default. Corporate default does not mean a corporation ceasing business. Corporate default simply means that a corporation can no longer service its debt, that it can no longer pay the interest payments due on its issued bonds. That is default. If I'm a corporation and I make $2 billion a year in revenue, and I have $1.5 billion in debt that I have to pay each year, I can afford that because I retain $500 million. Let's say that is at an interest rate of 5%. If the interest rate should double to 10%, all of a sudden I'm now paying $3 billion a year to service my debt on $2 billion revenues. That's not sustainable. I am now bankrupt. So that is a big, big, big problem out there. Corporate debt. Corporations start to default, it is going to fuck up this economy. The Fed can't do shit. They're sitting on $5 trillion of garbage assets. The interest rate is already low as shit. We are in a fucked up situation. The last thing I want to talk about in this specific video is currency. Currency is a means of exchange of value. What I say by means of exchange of value, if I buy a car from you, that car has value. How do I compensate you for that value? By something we both agree upon establishes reasonable value, and that's what currency is. So you think that car's worth 3,000? Here, 3,000 pieces of paper that you could take to the bank, or you could take to someone else and buy something else worth 3,000. So that currency contains value. Historically, all currency that has been issued by a nation has been backed by something of tangible value. I can make this value, and every dollar is equal to one of these. So if I issue a dollar, you could go get one of those. Or you could go to someone and say, you know what, I don't want the dollar, I want one of those. Gold, silver, copper, bronze, cowrie shells, even beans, whatever you want. It establishes a sustainable, easily identifiable value for that currency. You give me a dollar, I know that is an ounce worth of silver. I could go to the bank and say, give me silver, I don't want this dollar. In 1972, Nixon took the US dollar off the gold currency. Why did he do that? We were spending in Vietnam, we'd spend in Korea. We were printing money, more money than we could back up with gold. At some point in time, you had to break that link. At that point, the US currency became fiat currency. Fiat currency has its value established by the faith that the government that issues this currency can honor its debts. That's fiat currency. It's worthless. The problem with fiat currency is that it does not reflect reality. I trade currencies: Euro US dollar, pound dollar, Australian dollar US dollar, Canadian dollar US dollar, Japanese yen US dollar. I trade all that shit. They fluctuate for no basis. Trump could wake up one day with a bloody nose. Oh no, the president has a bloody nose, he's going crazy. The dollar tanks. Putin could decide he's going to invade Europe. The euro tanks. They have no fundamental value, only conceptual value, and the only real value they have is that you and I accept them. I'm going to stop right here because it's a little bit long, but I've established the fundamental principles upon which modern economic theory revolves. I've broken it down a little bit, dissected it, punctured some holes in it. So in the next video, I now want to start talking about Moe's economic theory. And then the video after that, how this theory can be applied to the black nation. Once again, thank you. God bless. And wherever you are, good night, good morning, good evening, good afternoon, good what the fuck ever. Thank you.